to thank Nick and Ben for placing me first, giving me the job of warming the audience up. So, we'll see how this works. My purpose here today is to give you a flood of facts about the mortgage business. And by way of bona fides, I was in the business from 1978 through 2007. I occupied all the positions in the production channel, from loan officer to senior vice president, with different lending groups. I want to give you the idea of sort of where all this stuff came from, but still give you the basic facts that you can use to interpret the information you get from the talking heads, newspaper articles, and magazines. And we need to start with just asking the question, where did this idea of home ownership come from that led us from there to here? In 1929, at the time of the last financial collapse, only 1 in 6 households owned their own home. That's completely opposite to the Norman Rockwell vision that you've been given, but that's the truth. 5 of every 6 families rented from Mr. Potter. And when FDR came into office and assumed the leadership for the Depression, he had to find a way to put the country back together. Now, he was under attack from 2 brand new political theories that hadn't existed before, Bolshevism and fascism. And his response was to create a stakeholder society, a stakeholder community. Of course, Social Security was a big part of that by putting a safety net, but the creation of the Federal Housing Administration, FHA, the savings and loan industry, and Fannie Mae. Fannie Mae was part of the federal government from the Depression era clear to 1969. And the idea was to create a mortgage through FHA that was an insurance company, borrower paid for insurance company, that created a small down payment, a fully amortized loan, because mortgages up to now required 30% down and were rollovers. Every 3 to 5 years you had to go back into the bank and renegotiate your interest rate. A fully amortized mortgage, so that if I hung in there for 30 years, I owned the house. And even less known is the creation of building standards, of uniform building codes, which were then later adopted over 40 years by cities and counties. So the FHA created this insurance company that could make these loans. FDR went out to the banksters, they were still banksters back then, and offered them this program, which they refused, of course. So he then created a new industry called savings and loans, modeled on the British Building and Loan Company. But of course they had no capital at first. So he then had to create the Federal National Mortgage Association, which we know as Fannie Mae, so that savings and loans would make the loans, the government would insure the loans, the other hand of the government would buy the loans. So it was kind of a foolproof way, to create a cycle, which we later started calling the secondary market. Now, from the Depression to the late Carter administration, we increased the rate of home ownership from 1 in 6 to just a little bit under 2 out of 3. That was about a 64% home ownership rate under the Jimmy Carter administration. Fast forward to 2009, we have hit the top that we have at 69.4. Not a lot of movement between Carter and Obama. And try to hang on to that fact because it will become important. If I had a little bell up here as a professor, I'd say midterm. Now, in this 40 years, we're moving along. We have the new VA program in 1944, and we're moving home ownership up the line. The next big event to happen was the creation of mortgage-backed securities. That occurred in the very early 80s. It was fathered by a man named Louis Ranieri, who was then part of the largest investment banker called Salomon Brothers. And the idea of the mortgage-backed security is an idea who had great intentions but unintended consequences. The mortgage-backed security expanded the funding for mortgages. There wasn't enough money to keep up with the demand of the baby boom generation, and so mortgage-backed securities attempted to make mortgage debt look like a stock, look like a bond, and therefore attract investors that could not, participate in the real estate, mainly the pension funds. So local pipe fitters 101's connecting New York with one filing case, and the guy with a green eyeshadow and a garter on his sleeve could now buy mortgages because he could slip them into that little filing cabinet. All he had was a couple of pieces of paper. this expanded greatly the basis for doing more and more mortgages. The unintended consequence, however, was that we then fueled what happened in the 1980s, which I call financialization of America or commodification of America. We switched doing mortgages as an asset. We didn't want to make the money from the mortgages. We went from originate to hold to originate to trade. And the idea was born, let's just make money off trading. Let's just make money off the money. Any place we can get an aggregate of cash flow, we can manipulate the cash flow and we can trade on the market, and we can make money whether we're actually doing anything of importance or not. So that was the unintended consequence. The next big thing was in the late 80s and early 90s, the creation of the mortgage brokerage industry. It didn't exist before. And the mortgage brokers, again, are a good idea. They're flexible, they're independent businessmen, they can open quickly and close quickly, they can give borrowers more choice because they may be representing a dozen different lenders, so the borrower has a better chance to look at different mortgages and hopefully lower prices. The problem is it's unregulated at the beginning. In fact, it's barely regulated now. Now, the mortgage brokers went from, in the late 80s, just getting started, to the year 2000, they originated 65% of all the mortgages. So you have a fairly unregulated group of people that are offering the products to the consumer and originating them. The next event that occurred in this crisis, or this lead up to the crisis, was the invention of subprime mortgages. This occurred in the early 90s. Now, some of you will remember that at that same time, the junk bond market associated with the name Michael Milken collapsed. This left a void in the market for investors, and I will quote Robert Rubin here, Clinton's Secretary of the Treasury and later the head of Citicorp. It left a void in the market for those investors who were reaching for yield. Doesn't that sound nice? It's sort of a pastoral idea of a guy in short pants skipping through an orchard. I just want the better apple. Instead of the arterial greed that Bob Dylan sang about, which is what it was. So we created this subprime mortgage. Well, what is it? There's three types of mortgages, general types of mortgages in the market. The first is prime, a prime mortgage. A prime mortgage means that we document everything, not just the property, but we document your income, your job history, your credit, all of the things, and it's all researched and documented. That's a prime mortgage and the majority of mortgages. Then there's a thing called Alt-A. Alt-A is a prime mortgage where you do not have to disclose everything. Maybe it's your income, maybe it's your assets. It's compensated for by a larger down payment and a higher credit rating. So those are different from prime, but they're all higher.
Interest rate.
Yes, usually.
You said higher credit rating. That isn't, I don't compute with that.
Well, we wouldn't give you the loan. If we're making prime loans, say at 620 on your credit score, and you came into us for a no income, otherwise fully documented loan, yes, we might charge you, but we would require a larger down payment, 10% instead of 5%, and we would require a credit rating of 680.
Okay.
So that's what I'm saying. It was for those kinds. It's not a subprime loan. It has some compensations. Then this thing called the subprime came about, in which we would just blow all the rules out the door. For people with less than stellar credit could still get a mortgage with a high loan to value. By the time we got into the last decade, it was 100% loan to value, less credit, and no documentation. It was a crazy thing to have ever even thought of, but of course it dove down to some borrowers that hadn't owned real estate before being able to get a loan. The subprime mortgages, by the year 2000, going from this early 90s to the year 2000, were 8% of the total market of mortgages. Still, okay, we can probably control that. But by 2005, they were 21%. Well, when you look at the foreclosure statistics of the percentages of those loans that went bad, they could pollute the entire pool of mortgages just with the foreclosures from the signing? What's 3?
3 minutes.
3 minutes? Gosh. Okay. 1999, we repealed the Glass-Steagall Act. The Glass-Steagall Act was passed during the Depression to keep commercial banks, investment banks, and insurance companies separate. There had been 12 bills, introduced to Congress to repeal the Glass-Steagall Act, and it finally happened in 1999, allowing the further consolidation of the big lenders. Then the housing bubble. All through the 90s, you had a nationally 3% rise in prices annually, nationally, up to the year 2000. From 2000 up until 2006, it was 9% annually. You could double the value of your house in 4 to 5 years, and in some markets even faster. And the result was chaos. The volume of transactions that were handled by mortgage lenders in those first 5 years, 6 years of the last decade overwhelmed the business. You couldn't create enough skilled people to help it at all. And they were overworked, and they were overworked for years. The majority of these underwriters and appraisers are women, and there's only so much you can do to keep your body and soul together and still deal with this situation. They were overworked. Middle management, those people in the trenches, were feeling pressure from the Wall Street all the way down through their senior management, and from the borrowers and the originators up here, and they more or less chose to follow the Dr. John rule. If I don't do it, somebody else will. If I don't do it, somebody else. You got to help out here. You guys know the song, but that's what they were doing. To give you just a comparative thing on the volume, 1979, the national volume for mortgages, which is my first full year in the business, to 2005, 2 companies, Countrywide Funding and Wells Fargo, did the same volume as the entire country in 1979 monthly. Oh, wow. The system could not handle it. We ended up with the leverage, which is a real hidden culprit in this whole crisis of mortgages. We had terrible leverage problems. Commercial banks like B of A and Wells Fargo were operating at 10 to 1. In other words, if I have $100 billion worth of assets, I can do $1 trillion worth of loans, which can then, by the time you start doing the foreclosures, you eat that up in no time at all. Fannie Mae was 27.1 to 1, which is why they get such a bad name. But the worst is Freddie Mac, 67.9% to 1. They can't be, they need to be closed, they need to be done away with, they cannot recover from that. And of course that's when we got the too big to fail idea. And that had been around since the savings and loan crisis, but it got expanded. My last point, and I'll make it and close up, is the primary, I want to lead into the foreclosure thing. The primary barrier to modifying notes in the foreclosure process and keeping people in their house is buried in that mortgage-backed security. The security is sold to an ultimate investor. It might be a pension fund, it might be Saxon Bank in Germany, it could be a sovereign wealth fund, and it protects them against changes in those terms. The servicer of the loan, no matter who it is, isn't allowed legally to change those terms. Now we're seeing some smaller banks try to take on everybody. U.S. Bank, to their credit, an Oregon firm. I know of 2 instances where they chose to modify the note and then fight back through Freddie Mac to the investor and have won. But it's a drop in the bucket. Unless we change federal laws to put all these mortgages in what's known as a real estate mortgage investment conduit and change those laws to allow everybody to take a hit, including the investor, by changing and modifying the terms, I don't know how we're ever going to get out of this crisis. So we'll leave it there. My time is up. Sorry. I didn't know what you wanted to